If you own your home and you are 55 or older, there is a strategy available to you right now that most Australians either do not know about or believe does not apply to them. It is called the Downsizer Contribution. It allows you to take up to $300,000 from the sale of your home and move it directly into your superannuation, without it counting toward your normal contribution limits. For a couple, that is up to $600,000 combined. And here is the part that surprises most people. You do not actually have to downsize. You do not have to buy a smaller home, or a cheaper home, or any home at all. The name is a little misleading. What matters is that you have owned your main residence for at least 10 years and you meet the age requirement. In this video, I am going to walk through exactly how this works, who is eligible, what the rules are, and the key things you need to think about before going ahead. As always, this is general information only and not personal financial advice. The Downsizer Contribution involves complex superannuation and tax rules that interact with your age pension, your estate planning, and your overall retirement income. Please speak with a licensed financial advisor before making any decisions. The Downsizer Contribution is a special superannuation contribution that allows older Australians to move money from the sale of their home into super. It sits outside the normal contribution caps, which makes it one of the most powerful super strategies available to homeowners approaching or already in retirement. It was introduced by the Australian government to help people convert the equity in their home into retirement income. The idea is that many Australians have significant wealth tied up in their property, but relatively modest superannuation balances. The Downsizer Contribution provides a pathway to move some of that property equity into the more tax-advantaged super environment. Each eligible individual can contribute up to $300,000 from the proceeds of selling their home. For a couple where both spouses are eligible, they can each contribute $300,000, for a combined total of up to $600,000 from a single home sale. The contribution cannot exceed the total proceeds of the sale. So if a couple sells their home for $400,000, the maximum combined contribution is $400,000, not $600,000. The $300,000 per person limit is a cap, not a minimum. You can contribute any amount up to $300,000. There are 5 key eligibility requirements. You need to meet all 5. First, you must be 55 years of age or older at the time you make the contribution. Not at the time you sell the home. At the time you actually make the contribution. There is no maximum age. Even if you are 85 or 90 and selling your home to move into aged care, you can still make a downsizer contribution as long as you meet the other eligibility requirements. The age threshold was reduced from 65 to 60 in 2022, and then again from 60 to 55 from the 1st of January 2023. So if you believed you were too young when you last checked the rules, it is worth checking again. Second, the home must have been owned by you and or your spouse for at least 10 years before the sale. This is measured from the date of settlement of purchase to the date of settlement of sale. Importantly, the home does not need to be your main residence at the time of sale. It simply needs to have been your main residence at some point during the period of ownership. Third, the sale of the home must qualify for the main residence capital gains tax exemption, either fully or partially. Most family homes in Australia qualify, but if your home has ever been used as a rental property or for business purposes, you should verify this with a tax advisor. Fourth, you must make the contribution within 90 days of receiving the sale proceeds, which is generally the settlement date. This is the requirement that catches people off guard the most. If you receive settlement on your home sale, you have 90 days from that date to complete the contribution. If you miss the window, you cannot make a downsizer contribution from that sale. If you know you will need more time, you can apply to the ATO for an extension before the 90-day period expires. The ATO super line is 13-10-20. But extensions are not automatically granted, so plan ahead. Fifth, you can only make a downsizer contribution once in your lifetime. It applies to one home. Once you have made a downsizer contribution, you cannot use the same strategy again for the sale of a future home. This means timing matters. If you sell a modest home early and use the strategy, you cannot use it again later if you sell a more valuable property. Here is one of the most commonly missed aspects of this strategy. If only one spouse is on the title of the family home, both spouses may still be able to make a downsizer contribution. The non-owner spouse is eligible as long as they meet the age requirement of 55 or older, and the home was their main residence at some point during the ownership period. This means that even if the home has been entirely in one person's name for the past 30 years, both partners can each contribute up to $300,000 from the sale proceeds, for a combined total of $600,000 into super. For couples, it is also worth thinking about which partner's super receives the contribution. If one partner has a much larger balance than the other, directing more of the downsizer contribution to the lower balance partner can help balance the couple's combined super position and create more room under the transfer balance capital. The downsizer contribution has some genuinely favorable features compared to normal super contributions. It does not count toward your concessional contributions cap, which is currently $32,500 per year. It does not count toward your non-concessional contributions cap of $130,000 per year. And unlike non-concessional contributions, there is no total super balance test. Even if your total super balance is $2 million or more, you can still make a downsizer contribution. There is no threshold that locks you out. There is also no work test. You do not need to be employed or meet any minimum hours of work to make this contribution. However, the downsizer contribution does count toward your transfer balance cap. From the 1st of July 2026, the transfer balance cap is $2.1 million. If you move your super into a retirement phase pension account, your downsizer contribution counts toward this limit. If the contribution pushes you over your personal transfer balance cap, the excess will need to remain in accumulation phase where earnings are taxed at 15% rather than being tax-free. This is one of the reasons why the timing and structure of a downsizer contribution is worth discussing with a financial advisor before you proceed. This is the part that surprises many people who are also receiving the age pension. Before you sell your home, the family home is fully exempt from the age pension assets test and income test. It does not count at all. Once you sell and the proceeds move into superannuation, those funds become assessable financial assets. They count in the assets test, and the balance is subject to deeming under the income test. This can reduce your age pension payments. If your total assets were already close to the threshold, adding $300,000 or more in super could significantly reduce, or even eliminate your pension entitlement. This does not mean the strategy is wrong for you. For many Australians, the long-term tax benefit of having more money in the super environment outweighs the reduction in age pension payments. But this trade-off is genuinely important to understand before you commit. The process itself is straightforward once you know the rules. Before you make the contribution, contact your super fund to confirm they can accept downsizer contributions. Most major funds do, but it is worth confirming. Download and complete the ATO Downsizer Contribution into Superannuation form. The form number is NAT 75073, and it is available from the ATO website. You must provide this form to your super fund before, or at the same time, as you make the contribution. If you contribute the money without the form, your fund will treat it as a standard personal contribution, which has different rules and limits, and could result in the money being returned or taxed differently. If you are making multiple contributions from the same sale, a separate form is required for each one. Transfer the money to your super fund within 90 days of settlement. Confirm with your fund that the contribution has been received and processed as a Downsizer contribution. Let me bring it all together. 1. The Downsizer contribution allows you to contribute up to $300,000 from the sale of your home into super. For a couple, that is up to $600,000 combined. 2. You must be 55 or older at the time of the contribution, have owned the home for 10 years or more, and make the contribution within 90 days of settlement. 3. It does not count toward your concessional or non-concessional contribution caps. There is no total super balance test and no work test. 4. It does count toward your transfer balance cap when moving to pension phase. This matters if your balance is approaching $2.1 million. 5. Selling your home removes it from the age pension exemption. The proceeds become assessable assets. This can affect your pension entitlement. 6. You can only use this strategy once in your lifetime. Timing matters. The Downsizer contribution is one of the most powerful retirement strategies available to Australian homeowners. But because it interacts with your age pension, your transfer balance cap, and your estate planning, it is genuinely worth discussing with a licensed financial advisor before you proceed. If you think this strategy might apply to you, the best starting point is the ATO website at ato.gov.au, where you can find the full eligibility details and the NAT 75073 form. And before you commit to anything, speak with a licensed financial advisor who understands how the Downsizer contribution fits into your overall retirement picture. Thank you for watching. If this video helped you understand the Downsizer contribution, please subscribe. I post new videos every Wednesday and Saturday covering superannuation, Centrelink, and aged care in plain English for Australians in retirement. This Saturday, I will be covering the Age Pension September 2026 update, what changes on the 20th of September, how much the payments will increase, and what it means for your fortnightly income. That one is important for anyone already receiving the pension. Subscribe and hit the bell so you do not miss it. And if you have a question about the Downsizer contribution or whether it applies to your situation, drop it in the comments. I read every one. See you Saturday. Take care.